You're listening to Disruption Digest podcast, where we look at the world of AI in plain English. I'm Jamie Hugh, your host. With me, my partner in crime, Jarrett Miller. What's going on, Jarrett?
How's it going, Jamie? I'm glad to be back for another week. I'm especially excited about this week's topic. I understand you found yet another very interesting paper in this one. I'm a bit of a finance nerd, so I'm excited about talking about this one today.
I am hyped, Jarrett. I am hyped. How often do we talk about investing, right? So often. Very, very frequently.
We talk about finance and investing probably the most, and so to bring the two subjects together is going to be very interesting. I'm excited to see what it is that you have here.
100%. But before we do, we have to talk about JobsGPT, right? Every episode starts with JobsGPT. So I think it may be your turn once again, because I did last time. And so, again, just the concept is we've built this custom GPT. It's called JobsGPT. Basically responds to any questions as Steve Jobs would. And so do you have a question in mind?
All right, we're coming up on summer, planning summer vacations, maybe going to the beach. So the age-old question, if you were stranded on a desert island, what would you bring with you to survive?
Oh, classic. Okay. If you were stranded on a desert island. All right, I've got a great answer here. It says, first off, I'll bring a solar-powered MacBook because even on a desert island, one must have impeccable design and connectivity. Secondly, a Swiss Army knife. Not just any, but one designed by Johnny Ive, ensuring it's both functional and aesthetically pleasing. And lastly, a crate of lattes, because survival is no excuse to compromise on sophisticated taste.
All right, well, I've never heard of Johnny Ive, but now I might have to go look that up and buy a knife.
Oh, you don't know Johnny Ive? Johnny Ive is what was the chief designer for the iPhone. So back in 2006 and 2005, when they were building out the concept, he was the guy that came up with this concept, and obviously very revolutionary at the time. And so his influence has been running deep within Apple. Let's put it that way.
Okay, of course you would know this Apple stat.
Of course.
Apple fact.
Of course.
All right, Jamie. Well, first off, I love that you find these interesting papers all the time and are willing to read through them and dig through them as much as you do. So let's get into this particular paper that you uncovered out of, I understand, Chicago Booth MBA school. So what exactly is the synopsis of this paper that you found?
Yeah, for sure. I mean, here's the deal, right? The question that we all want to answer is, can we use generative AI to make us filthy rich in the stock market so that I can go retire and go to Hawaii, right? But the thing is, how many times, Jarrett, have we heard of the golden ticket, the secret formula to instant wealth and personal fortune? Just pay $199 for this one-time course.
Oh, I spent so much money, or people spend so much money trying to get rich.
I suspected.
People have gone broke trying to get rich.
Well, the synopsis of this course is now you don't have to, because you can just use AI, right? But on the surface, that seems tricky. So before I read this, I thought, this is very, very difficult. Large language models are very good with language. Go write me an email. Go write me a poem on dogs, or even song lyrics, right? It's great for that kind of stuff. But we know large language models are not as good with logic and with math, relatively speaking, of course. And so this paper from the University of Chicago Booth is about using AI to dissect financial statements. It's financial statement analysis and seeing what the result is. Now, this is a very recent paper. This was published, I'm having a look, May 20th, which at the time of recording is, just over a week old. And what the authors are wanting to do in this paper is seeing if a latest large language model, like GPT-4, for example, could analyze these financial statements as effectively as a human analyst.
Okay, so for the layman out there, can you explain what exactly financial statement analysis is and what it entails?
Right. So financial statement analysis is essentially a quantitative task that involves digging into key financial documents that companies release. For example, the balance sheet or the income statement or the cash flow statement, right? So these are documents that provide a pretty detailed look at a company's financial health and performance. And so it's very heavy on analyzing trends and ratios. It's very mathematical, and there isn't a great deal of wording. So it's very focused on the logical side of running a business.
Okay. So before you read this paper, your initial thought, did you think, knowing that LLMs do not do very well with math just yet, we kind of unpacked that in last week's episode. Did you think that AI would do well compared to humans?
Hell no. Oh no. I thought this thing would get destroyed, right? And I would say this, we've seen GPT do well in exams. So, for example, answering CPA exam questions. But the reason it does well in those situations is because it relies on this concept called memory. So it's gonna, if you're feeding a bunch of sample questions, it's gonna get the gist of it, and it's gonna learn what similar questions are going to output. But this is purely logical; it's mathematical based, and so based on the setup and the fact that it's a very difficult thing, even for humans, is very difficult. I thought this would be a step too far, right? A bridge too far, so to speak.
So tell us a little bit more about this experiment.
Right. So the research involved passing essentially a real balance sheet and income statement from various different companies that were publicly listed. And so we're talking real historical data from the past sort of 50 years or so, right? And it's all standardized and fed into GPT-4 Turbo, I believe, which is the recent model. And they asked the model to predict whether a company's earnings would either grow or decline in the following period.
Okay, and they did this, they asked it to just analyze the balance sheet and income statement, so no annual reports with any other text included.
Right. So that's the interesting piece. What the researchers did was they intentionally handicapped the large language model by giving zero additional contextual information, right? So the name of the company was stripped out. Even the year was taken out, and certainly no annual reports. And they actually said, and I have this in front of me here, it says, our primary interest lies in understanding the large language model's ability to analyze and synthesize purely financial numbers. So it was an intentional decision to not bring that additional information in, Jarrett.
Interesting, because we can often, as we're analyzing stocks, whenever I go and analyze a company myself, I come in with a bias that I just can't get rid of, oh, I know and trust this company, therefore I'm going to read these numbers in a more positive light, or if I'm reading numbers of a company that I don't necessarily trust as much, I'm going to be a little bit more pessimistic. So this ability to anonymize it is going to be highly useful whenever going in and doing your own analysis, if you choose to use these LLMs to help you do your analysis on your own. So were they measuring against humans or other AI models?
To answer your question, both. So in the research, they wanted to answer three questions, Jarrett. First, can a large language model generate economic insights purely from the numbers reported in these financial documents? Second, how does it perform against a human? And then also against a specialized machine learning model that's been fine-tuned for this very purpose. And then third, can the economic usefulness of GPT's forecasts be used to predict stock price movements, which I think is the biggest and most interesting use case.
Mhm.
So for the first one, let's dive straight into the data. I'm going to go ahead and share my screen. So we're looking at the chart on the left, and this is the prediction accuracy of GPT based on the experiment that we just talked about over the period of time of data that they analyzed, running from 1970 all the way to very recently to 2020. And very helpfully, they've drawn us a little trend line as well. And we can see that initially it started off pretty good, right? Around 65% accuracy, which is pretty astounding, really. So what do you think of this?
Can you define accuracy as they've defined it here?
So basically, the question to the model is, will the stock increase in price or decrease in price? And the model is trying to predict that. And if it was yes, they got it right, then that's accurate. If it
Okay.
was not accurate, then they just simply mispredicted it. So obviously 50-50 would be the default, right? And so anything over that is a sign of accuracy.
Yeah. So yeah, obviously, if you can gain a 10% advantage over the market in your prediction of stocks, you're going to have a huge advantage here. But it looks like the model, at least early on, was getting 15% accuracy over just a 50-50 random chance. And if you look a little bit later on in down market years like 2000 or 1999 and 2000 and 2009 and 10 and even 2020 with COVID, it still had a 50% accuracy rate. But the other years where the market wasn't going insane, the accuracy rates are much higher.
Yeah, I agree. I think there are times where this model does better, and we can only speculate why certain years are worse than others. But it does look like when there's a lot of volatility in the market, then maybe financial analysis is just difficult for a large language model because there's a lot of weird and unusual stuff going on. And maybe with human nuance, that can be better understood. But with the model, because it's only given those financial documents and no further context, it's difficult for it to be accurate.
Right. There's a whole lot more external factors that impact the price of the stock outside of just the balance sheet of the company. Uh, and it looks like the larger factor of the overall economic conditions of the market impacted the performance of the stock outside of what the LLM was able to predict. But whenever market conditions are somewhat normal, it looks like it's if we exclude those outlier years, it looks like the accuracy of the model might even be higher than 65%. It's interesting that the trend line and accuracy is going down over time. Did the paper give any? Did the paper address this fact or give any insights into that?
Not really, but we can probably again speculate on some of this, right? It's very interesting. And again, just to be very clear, this paper is the first of its kind to analyze this kind of use case. And so there's going to be a lot more work that needs to be done, in my opinion, to really understand some of the capabilities and limitations to using a large language model. But I would guess that as time has gone on, there's been more esoteric investment strategies being used, right? We know that there's quants and bots and automation that's happened that is at the millisecond level in trading and in stock. And so, maybe that's part of the factor where those cause some unusual results. I don't know. I mean, I don't know if that's even reflected in the financial statements, but it certainly looks like as time's gone on, people have gotten maybe better also at utilizing the numbers. So suddenly this analysis is less, it gives you less of a competitive advantage against the market. I
Yeah,
don't know. What do you think?
I think that's a great theory that as time goes on, quantitative analysis removes some of the efficiency and advantage that this particular strategy might have. What about the accuracy of the LLM model versus other machine learning models?
Yeah, that's a great question. So the researchers ran this experiment and essentially first compared it to the recorded forecasts by human analysts. And essentially, GPT was able to match the median financial analyst in terms of prediction accuracy. So we're looking at the chart on the left here. And the ones we're comparing is GPT without COT. I'll come back to the COT in a little bit later. And we're also comparing against Analyst 1M. So we can both see that they're about 52% accurate.
All right, Jimmy, you mentioned COT. Can you explain what COT is?
Right. COT stands for chain of thought. And so the best way to explain it is, let's think of a really complex problem for an AI to solve. Write me a book on how to build your own business, right? And giving all that in a single prompt to an AI may result in a subpar result because the AI sucks at planning. So what do? We can break it down into smaller parts. First, go ahead and do some research on building a business. Then, what would be the overall narrative? Then, what would the chapters be? Then, write me chapter 1. And so this is a sequence of logical steps which is fed into the AI model sequentially. And that helps the AI return much more accurate and coherent answers. And that's exactly what COT is, chain of thought.
So it's essentially somebody went in there and fed the GPT the questions that a great analyst would typically ask about a stock to get the GPT to look at the stock in a way that a great analyst would, and then at the end ask the GPT based on all the previous questions that you asked, do you think the stock is going to go up or down?
Exactly right. Exactly. So we're basically enhancing the large language model's performance by step-by-step instructions, to your point, that emulates best practice processes typically followed by financial analysts that we know works. And so if we look at the results with COT, which is this bar chart on the very right side of the leftmost chart here, with chain of thought, GPT-4 comfortably dominates the performance of a median financial analyst, and also beats itself without COT. And that's really, really significant, right? Because this is using the same model, but the difference in prompting is enough for a 8 percentage point difference and makes it the clear leader against humans.
That's interesting because I would think that now instead of having a proprietary machine learning model that you have to create to beat the market, it might be much easier to think of your own chain of thought questions to ask the GPT model, or have the GPT model ask of the income statement, and you can much easier or much more easily generate your own stock analysis tool.
Yeah, for sure. And so that you bring up a really interesting point, which is what is the performance against state-of-the-art machine learning models that were specifically trained for this kind of work. And so we can have a look at the data too. And I'm going to scroll down to the next page. So this is the performance again against these state-of-the-art machine learning models. The graph that we're looking at, the chart, is the one on the left. And ANN is that state-of-the-art model. GPT with COT is the one on the right. And we can see that these are comparable. That what's interesting is the researchers broke down, because this is just average, they broke down where each excelled, and they tended to excel in different areas. When more data was available, these machine learning models were great, but when less data was available, when, for example, we're looking at smaller companies without so much data, GPT was better. And so this is very interesting because it shows that these two things can be combined for ultimately a better result. Not much research in terms of how we can combine them, but the potential is there.
So interesting. I think it's going to greatly lower the bar for people that want to go and create their own proprietary, individuals that want to go in there and create their own proprietary way of analyzing and treating or trading stocks. It's going to greatly lower that bar and barrier to entry to where a lot more people are going to be able to do this. Just think of a line of questions on your own and create this, versus I don't know the first thing about creating a machine learning model myself, but I can go in here and create my own line of questions based on either some literature that I've read, or a book like Benjamin Graham's book on investing. Create a Benjamin Graham GPT, just like we have Jobs GPT here to help beat the market.
No, for
So
sure.
is this going to be the status quo for investment firms moving forward, do you think?
I think it's going to be very commonly used, yes, because to your point, it's going to greatly reduce the experience, skills, and everything else needed to make relatively good predictions, right? I mean, you and I could do it. I don't have any finance education. formal education, and I could build this model and get really great predictions. And so based on that, and also based on the fact that it's complementary, I think why not have it, right? I mean, there's no disadvantage. This is just another tool that these financial organizations can use. But more importantly, it's going to open the possibilities of this type of ability to anyone. Historically, these fine-tuned machine learning models were expensive, difficult to build, and not available to the mass market. But we know what GPT-4 is. So that really is going to change the way people invest, I feel.
All right, so we see that the chain of thought can be used to predict price performance. Can it be used to make money in some way?
The ultimate question. I think if it couldn't, then all of this is interesting, but not particularly useful. So the researchers knew GPT-4 could forecast whether earnings would increase or decrease based on the evidence we've seen. And so to your point, they wanted to see if they can form an investment strategy using this information. So I like to think of this as the difference between physics and engineering, right? Planck, Schrodinger, they figured out quantum physics, but it was IBM and Intel that made billions of dollars through the investments of chips and computers. And so to answer this question, these researchers played a hypothetical game. The researchers were start in 1970. They had GPT-4 forecast all the stocks in 1970, and they looked at three things: direction, magnitude, and confidence. Is it going to go up or go down? What is the size of that? Is it going to go up a lot or just a little bit? And how confident are you of this prediction? And then after they got the results back, they took the top 10% of forecasts that GPT-4 predicted to experience a big increase and were the most confident, and the researchers basically would take a long position, right? They would buy. And then for the top 10% of forecasts that GPT-4 predicted to experience a decrease, which is the inverse, the researchers would take a short position. And they would then hold this portfolio for a year, measure a couple of really key financial aspects. For example, the Sharpe ratio and alphas. So I'm going to show you the result. But the chart on the left is the monetary returns over time. So I just want to point out that this is log, right? So again, this is just a condensed version, but it shows that both the long and short strategy were profitable. But even if that's the case, that's not really a big deal if it can't beat the market. The ultimate goal is, can it beat the market? If I just bought the S&P 500 and just invested into the market and this strategy doesn't beat it, then it's pretty meaningless. So the chart on the right showcases the combined strategies, that's both the long and the short, versus the market. And the crazy thing is, Jarrett, and I want to get your opinion on this, but over this period of 50 years, this strategy with AI, bear in mind that it doesn't have contextual information or anything else, was able to comfortably beat the market.
It's comfortably beating the market with less volatility. So if you see the market, I mean, it obviously has ups and downs, especially in the year 2000, 2008. But the LLM model actually just continued a steady climb. So there's looks like there's a smaller beta than even the market has. And it's not just beating the market, it's destroying the market.
Right. And so to your point, the Sharpe ratio, which is a measure of the reward to variability, that is 3.36. And just for everybody out there, anything over 1 is good. It just means that there's a great return for the risk, the type of risk of investment. And so that is, as you can see on the chart, just very clearly shown by the very straight line without too much jagged ups and downs, whilst the market itself had a lot of downturn, right? We can see big downturns in 2000, around 2008, when these massive corrections happened. So it's incredible. I've got some numbers here that the average rate of improvement of the market is about 10%. So that's alpha. So it was able to beat the market year on year, 10% every year, which is
Wow.
it's just nuts. So This sounds like you and I, Jarrett. We need to start using this into our analysis for buying stocks, you know?
Either that or, firms, actively managed firms did start strongly adopting quantitative analysis recently. So do you think that actively managed firms are going to start adopting this more and more? And are they going to start advertising their proprietary chain of thought uh, lines of questioning, I guess, or I'm not even sure what you call a chain of thought. Are they going to start saying, hey, we have a better proprietary chain of thought to ask the GPT that's going to yield better results?
Yeah, I mean, I think so. But the other thing is this going to destroy their business model? Because why would I go pay somebody a lot of money to manage a fund of all these things and let them take a percentage when I can ask AI to do it for me for free? I'm sure somebody's going to come out with some kind of custom GPT bot or, some kind of lightweight product that essentially does this for 0.1% or something, or way less. Why would I even bother taking these active funds? I can't imagine they'll be able to beat 10% year on year consistently on top of what they do.
Yeah, I wonder how. So the reason why is because they could advertise, I have a better chain of thought line of questioning than anybody else on the market that's going to lead to a better return. But I wonder if eventually you can see, does a proprietary excellent chain of thought outperform a just very basic one that you can go read any sort of stock investment book and create a chain of thought yourself? Does the proprietary chain of thought outperform that basic one by leaps and bounds enough to offset the fees of the actively managed firm plus some additional profit that makes it well worth going after this, or going and finding and doing my own research on the actively managed fund?
Great question. So I would say this, Jarrett. If you think about the chain of thought, the actual prompting itself, it is a very shallow moat, right? Can we agree
Right.
on that?
Yes.
So if somebody comes with this proprietary chain of thought, that's fantastic. It's not going to be very difficult for somebody else to copy it. And because they're not really doing the work, the the large language model is doing the work, you know? And so I think that is the ultimate problem with any actively managed fund that is going to be basing their supremacy on a proprietary chain of thought model or chain of
Right.
thought process, whatever you want to call it.
I also find it interesting that in the previous weeks we discussed that as it stands today, machine learning models are not as good at problem solving and math as humans are today. But it's the ability of machine learning, or sorry, of large language models to do math and complex mathematical problems is dramatically increasing. So as the LLM's ability to problem solve and do math increases, does the performance of these models start to grow exponentially with it?
So another great way to put it is, where's the bottleneck of these models, right?
Yeah.
Is it to do with the language? Is it to do with the logic side? And I think it is to do with the logic side. If, to your point, if this is an area where these models are growing much faster, then I expect that to be the limitation. And so if those problems are not solved, we're going to maybe go towards a period of stagnant growth for model capabilities. But potentially, because these things are being worked on, that means the large language models of the future are going to be that much more powerful. What do you think?
Yeah, I 100% agree. I would be interested after we get LLMs that come out and boast that they are great at problem solving. Let's rerun this study and see if the performance is even better, and see what impact that has on actively managed firms and or funds, and who else is going to go out there and adopt these things. Maybe I'll start building my own strategy preemptively so that when it comes out, I can go ahead and have my chain of thought ready to go and start making or beating the market.
Jarrett, you and I need to create a company right now. We need to get on this bandwagon. We need to make some money on the stock market. Listen, that's all we have time for today. Really interesting topic, right? It's kind of curious that all these things are coming out. Never a dull moment in AI. Appreciate your time as always.
See you guys next week.